All right. I promised you at the beginning we were going to talk about retirement accounts for the self-employed. Okay. So let's start at the very beginning of this. When you're self-employed, you are the employer. You are the employer and you are the employee, right? And so you're responsible for all the benefits. You got to line up the health insurance. You got to line up the retirement accounts. You got to line up the insurance. You got to line up everything. Yes, all that can be paid for with pre-tax dollars, which is nice, but you got to do the work. The benefit, though, is you also get to choose the benefits. You don't have to buy benefits you don't care about. If you don't need life insurance, don't buy life insurance, right? If you need a really great retirement plan, you can go out and get a really great retirement plan. Same with, high deductible health plan and HSA and that sort of stuff. You can go do that when you're self-employed. It's in your control. And that's one of the best things about being self-employed. As a general rule, when you become self-employed, you need to be paid a little bit more than you were as an employee because your employer is no longer paying for anything. They're not paying for the other half of Social Security taxes. They're not paying for any of the benefits. For a typical doctor, if you're going to go 1099, be self-employed, an independent contractor, you should expect to be paid about 10% more to make up for all that stuff. You got to run the numbers individually, but that's a rule of thumb, about 10% more. So if you were getting paid $250,000 to be an employee, maybe you ought to be getting $275,000 to be self-employed to be equivalent. All right. So keep that in mind. You generally got to be paid a little bit more. But at any rate, when you go to get your retirement account, the mainstay for a self-employed physician, and this is whether you have, an employee gig on the side or not, is the individual 401k. And if you have an employee gig, you can have two 401ks. Okay? Don't let that stop you. Yes, you got to understand all the contribution rules, but you can have two 401ks. And generally with two, 415C limits, which is, for those under 50 this year, is $66,000 limit that can be put in there. That's the total between you and the employer put into the account. So this is the mainstay of your retirement savings when you are self-employed as an individual 401k. And this year, if you're under 50, you can put in $22,500 as an employee contribution, but you can make up the rest of that $66,000 as an employer tax-deferred contribution, or you can make it up as an employee after tax contribution. And if you set up the plan right, if the plan's set up for this, you can make those after tax contributions and you can immediately convert them to Roth if you want. So lots of options there, both on the Roth side, the tax deferred side, whichever one makes more sense for you, which is generally tax deferred if you're in your peak earnings years, but that rule of thumb has plenty of exceptions. Okay, so that's the mainstay. Your first $66,000 in savings for retirement is probably going into an individual 401k. Your other options, everybody that has earned income or whose spouse has earned income can do an IRA contribution. Now, for most of us docs, most of us high-income professionals, we're doing this via the backdoor Roth IRA process for ourselves and for our spouse, right? $6,500 this year if you're under 50, $7,500 if you're 50 plus. For each of you. Even if one spouse isn't working, you can still do one of these for each of you. So that gives you another $13,000. So we're up to $79,000 that you can save for retirement. And that covers most people, even most doctors. If you're saving $79,000 for retirement, awesome. Good on you. You're probably done. A lot of people can't even max both of those out. But if you want to save more, there are other options. Okay. An HSA. If the right healthcare plan for you is a high deductible health plan, you should definitely use an HSA. This triple tax-free account may be the best investing account out there. It's the first thing I fund every year. And the exact contribution amount for 2023 eludes me. For a family, it's around $7,000 something. For an individual, it's about half that. That goes up each year with inflation. So you can get a few $1,000s more into your HSA and use that for healthcare either now or in retirement, or even after age 65, you can take the money out, pay taxes on it, but without penalty, spend it on non-healthcare stuff. Okay, let's say you're just absolutely killing it. You're making tons of money and you want to save even more for retirement. Well, there's another good option called the defined benefit cash balance plan. And you can have a personal defined benefit plan or personal cash balance plan, even if you're right? You're an independent contractor. Schwab, for example, offers these. You can go to the people we recommend under our recommended retirement account provider page, and they can set up custom plans for you, but both a customized solo 401k or individual 401k that allows you to do after-tax contributions and conversions, or a personalized defined benefit cash balance plan. But depending on your age, you might be able to put a ton each year into cash balance plans. I've seen contributions as low as $500,000 or $5,000. I've seen contributions well over $100,000 per year. It's actuarially determined because this thing has to masquerade as a pension. So the older you are, the more that can actually be put in there. All right, even if you've maxed all of that out, you can always save more in a regular old non-qualified taxable brokerage account, right? You can buy stocks, bonds, mutual funds, whatever. You can go buy investment property, anything you want, right? There's no limit in how much you can invest in a given year. There's only limits in how much you can put into a retirement account. Now, the big question a lot of people have is, what about a SEP IRA? My accountant says I should use a SEP IRA. Well, SEP IRAs are pretty good, right? They're better than nothing. They're almost always going to be better than a simple IRA, which occasionally a small practice with a few employees will use. But the downside of a SEP IRA is the balance in there counts against you when you go to do the backdoor Roth IRA process. Essentially, your conversion gets prorated, and that's not a great thing. And so that's why most docs, other high-income professionals that are self-employed, should be using an individual 401k instead of a SEP IRA. At some income levels, you can contribute more to an individual 401k than you would be able to with a SEP IRA, because you have that employee contribution that you can use. You also have this option, if the plan's set up for it, to do after-tax contributions. Now, starting this year, SEP IRAs are supposed to be accepting Roth contributions, which would obviously keep you from being prorated and might solve that issue. In practice, I'm not sure I've run into one yet that's taking Roth contributions, but hopefully by the end of the year, you'll see that at Vanguard, Fidelity, Schwab, those sorts of places. But as a general rule, SEP IRA is the wrong choice for a doc. A solo 401k, or also known as an individual 401k, is the right option. Okay? Once you have employees, this is no longer a do-it-yourself game. You need professional help. You ought to get your practice studied. We got that list of retirement account providers on our recommended list. You ought to talk to those people and help them decide what the right plan is for you and your practice or your small business. It might be a 401k. It won't be a solo 401k, not once you have employees that aren't your spouse. It might be a SEP IRA. It might be a simple IRA. It might be no plan at all. But you got to kind of have your, practice and employees and how much you want to save studied to figure out what the right plan is for you. I hope that's helpful in understanding self-employed retirement accounts and how they fit into your life.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.